Hello, I'm Munffett. In today's market, it really feels like we're all trying to navigate a minefield of stories. You've got the AI boom on one side, you've got big questions around e-commerce on the other, and frankly, it's getting tougher and tougher to separate the real signal from all that noise. So, in this review, that's exactly what we're going to do. We're going to cut through it, take a hard look at how our portfolio is positioned, and really tackle these big debates head-on. All right, let's jump in.
Okay, before we get into the thick of it, just a quick but very important note. Everything we're about to discuss is for informational purposes only. It's a look at our own analysis, our own thinking. It is not and should not be taken as investment advice.
So here's our game plan. First, we're going to review our own portfolio, where we stand right now. Then we'll zoom out and look at the broader market, which is really a tale of competing narratives. After that, we'll dive deep into the AI dilemma. Is it a revolution or a bubble? And finally, we'll tackle e-commerce. Is it a goldmine or a money pit? Let's get to it. All right, Section 1, our portfolio review. We're going to start with our current stance. Before we can even begin to make sense of all the cross-currents out there in the market, we have to have a crystal clear picture of our own ship, where we're anchored, and just as importantly, why.
So here's a look at what we're holding right now. As you can see, this portfolio is built with balance in mind. That's absolutely intentional. On one side, yes, we have significant stakes in the big tech titans, the Microsofts and Alphabets of the world, that are really shaping the future. But we anchor that with what I like to call real economy stalwarts. Think companies like Moody's, GE, Danaher. This blend, this mix is crucial because it lets us participate in those huge growth stories, but it keeps us from being completely at their mercy.
Okay, let's talk about a couple of key adjustments we've made recently. First, we've actually increased our position in NVIDIA. Now, believe me, I'm naturally skeptical of market euphoria. It's just my nature. But the fundamental demand for their technology is simply undeniable. The AI infrastructure build-out is happening, it's real, and they are the primary enabler. On the flip side, we've trimmed our position in Intuit. Look, they did a masterful job navigating the AI narrative, and the stock price absolutely reflected that success. But at 40 times earnings, it just feels like the market has already given them full credit, maybe even extra credit. We think there's better value right now in other high-quality software names that just haven't had that same kind of run-up.
Which brings us to our second section, the market, a tale of narratives. Because, of course, those portfolio decisions we just talked about, they don't happen in a vacuum. To really get why we make them, we have to understand the market itself. And right now, I see the market as a massive tug-of-war between two very powerful and often opposing forces. So on one side of the rope, you've got this incredible pull of narrative momentum. Think of it as the market's story of the day. Right now, obviously, that's AI, and it just sucks in capital. But on the other side of the rope, you have the steady, heavy pull of business fundamentals. The boring stuff: earnings, cash flow, competitive moats. Now, here's the thing. Eventually, gravity, the fundamentals, always wins. It has to. But, and this is a big but, over a 2, maybe even a 3-year horizon, a really compelling story can seem to defy gravity. And that can create a very painful, very frustrating disconnect for anyone who's just focused on the numbers.
And that leads to this difficult reality that we're all facing. As I see it, in today's market, it has become incredibly difficult to bet against a dominant narrative. In an age of instant information, social media, fighting one of these big stories is like trying to swim against a tidal wave. You might be right on the fundamentals, you might have the math on your side, but the sheer force of the story can be overwhelming, and it can be very, very costly for a long, long time.
And this whole narrative effect, it gets supercharged by the flood of money into passive investing. Think about it. When you buy an S&P 500 index fund, where does your money go? It automatically flows into the biggest companies. And which companies are the biggest? Well, they're the ones with the most powerful stories. So you get this crazy feedback loop. The story drives the stock up, which means it gets a bigger slice of the passive money, which drives the stock up even further. It's become a monster of a force to compete against.
Okay, Section 3, the AI dilemma, revolution or bubble. Because let's be honest, there's no bigger, no more powerful narrative in the market today than artificial intelligence. This isn't just another theme of the month. It has become the central question that every single one of us as investors has to grapple with.
And this really is the trillion-dollar question, isn't it? Is what we're seeing a genuine generational transformation, something on the scale of the internet itself, or is it a classic speculative bubble just waiting to pop? The way I see it, the answer is both. It's a revolution wrapped inside a bubble. At the core, there is absolutely a legitimate game-changing technology, no doubt about it.
The danger is that the market's expectations have taken that truth and just extrapolated it into the stratosphere.
You know, the core tension in this whole AI story can be broken down into a pretty simple three-step process. So step one, building the infrastructure. This is happening at a breathtaking pace, massive spending on GPUs, on data centers. Step two, training the models. This is where you hear about scaling laws, which is really just a fancy way of saying the more data and computing power you throw at a model, the smarter it gets. Simple enough. But the giant question mark, the thing that keeps me up at night, is on step three. Where are the real-world applications? We're still waiting to see the broad productivity gains that are supposed to generate a return on this absolutely enormous investment. And that gap, right there, between the build-out and the payoff, that's where all the risk is hiding.
And what this has turned into is a full-blown arms race. It's that simple. You have companies spending billions upon billions of dollars, not because they have a clear line of sight to a return on that investment, but because they are absolutely terrified of being left behind. It's a classic Cold War mentality, right? You build up your arsenal because you cannot risk your competitor having an edge. It's fear. That fear is what's fueling this incredible wave of spending.
So it forces us to ask that classic, uncomfortable question. Are GPUs the new tulips? I know, it's a cliché, but it's a cliché for a reason. And look, my concern isn't just about owning the tulip itself. It's the second-order effect, the fact that many of the companies we own in our portfolio are being forced to spend billions of dollars to acquire these things. That's a huge risk we have to be constantly aware of.
So how do we navigate this? Our approach is what I call cautious conviction. We're not AI deniers. Far from it. We have to acknowledge that this technology is truly transformational. But our job is to differentiate between the euphoria and the actual fundamental value. We have to separate the signal from the noise. For us, that means focusing our investments on profitable, established leaders, the ones selling the picks and shovels in this gold rush. And all the while, we have to maintain a balanced portfolio to protect ourselves from these huge, narrative-driven risks. All right, on to our final section, e-commerce. Is it a gold mine or a money pit? You know, AI isn't the only big story facing some tough questions. We need to talk about a sector that for a long time felt like an unstoppable force, but is now, well, it's kind of wrestling with its own identity.
In this question, this really gets to the absolute heart of the e-commerce debate today. Are these companies building durable, profitable fortresses with deep moats, or are they just stuck on a capital-intensive treadmill, running faster and faster and spending more and more just to stay in the exact same place?
Now, the bull case is still powerful. You can't deny it. It's really built on three pillars. First, you've got the classic network effect. More sellers attract more buyers attract more sellers. It's a beautiful flywheel. Second, and this is the hidden genius of it, you have a super high-margin advertising business that effectively subsidizes the low-margin retail operation. And third, you have a logistics network, an advantage that has taken decades and untold billions to build. That is a massive, massive moat to try and cross.
But the bear case is becoming just as compelling. That service gap in logistics, it's shrinking fast. I can get things from competitors just as quickly these days. The whole payments and checkout process that used to be a big advantage, it's become a commodity. And maybe most importantly, the competition for the customer's attention isn't just other retailers anymore. It's social media. The bottom line is, all of this requires constant, massive capital spending just to maintain what might be a temporary edge. And that just eats away at returns.
So it all boils down to this one fundamental question. Is this a winner-take-all market, or is it just an endless race of reinvestment? Is there an endgame, a point where you reach stable, high-margin dominance? Or is every competitive advantage you build just doomed to become a commodity? To be honest with you, it's a question I'm still wrestling with, and it's one we absolutely have to keep asking.
And that brings us back to our guiding principle, which is navigating all of this with cautious conviction. You see, whether we're talking about the explosive story of AI or the grinding reality of e-commerce, the underlying challenge is exactly the same. It's about respecting the power of these big, transformative narratives while never losing sight of the hard reality of valuations and competitive dynamics. It's a constant balancing act.
So I'll just leave you with this one final thought. We live in an age of narrative, an age where stories can move markets faster and further than ever before in history. And in this kind of environment, the single most critical skill an investor can have is the ability to separate the enduring signal of real, fundamental change from the absolutely deafening noise of speculation. That's the challenge for all of us. Thank you.